Hello and welcome to your March Investor Update. I'm Mann, Savings and Investment Specialist and Head of PR here at Nutmeg. In line with the current UK government guidelines, we're continuing to work remotely at Nutmeg, so I'm joined today virtually by our Chief Investment Officer, James McManus. Hi, James.
Hi, Kat.
James, February seemed to be a mixed month for markets, with a few challenges in particular for tech stocks in the last week of the month. How did global markets perform in the month of February?
That's right, Kat. We did witness some volatility towards the end of the month in stock markets, particularly in US technology stocks that ended the month weaker than the wider US stock market as bond yields rose. But February on the whole was not a bad month for equity investors. Developed markets ended the month in positive territory, gains of around 2.6% on the global equity markets, and emerging markets delivering returns of around 1%. But similarly to January, it was a tale of two halves. Equity markets rising in the first half of the month before giving up some of those gains in the latter 2 weeks. But while technology heavy indices such as the Nasdaq 100 ended the month flat, our favored US stocks delivered muted gains of around 2.6% in line with global peers. European and Japanese shares actually fared much better than that, delivering returns of around 3.6 and 3.3% respectively. And closer to home, the FTSE 100, still one of our largest underweights in our portfolios, was one of the worst performers in developed markets, gains of just 1.6%. Yet the FTSE 250, a segment of the UK equity market that we've preferred of late, performed relatively strongly, up around 3.5% for February.
Thanks, James. And what were the main drivers of market activity in February?
Well, in February, we've seen continued broad strength in macroeconomic and earnings data, particularly in the US, where the new Biden administration has also passed its latest fiscal stimulus package in the final days of the month, another $1.9 trillion of stimulus on top of the around 15% of GDP that has already been committed. And that positive data trajectory is also echoed in global trade data and in buoyant activity data across the global economic complex as lockdowns ease and vaccine rollouts accelerate. Now, that higher activity, the continued momentum in some of that macroeconomic data, and the associated rise in broad commodity prices in recent months has really led investors to reassess expectations for one key issue, and that is inflation. And in February, we've seen bond investors become much more concerned about the outlook for inflation and what that means for the medium-term removal of some of the support measures that are in place from central banks. Now, government bonds in particular have borne the brunt of investors' fears, with the yields rising across the government bond spectrum in developed markets, and that causes prices to fall and it inflicts losses on bond investors. That potential for higher bond yields is something that we've been concerned with for some time in our portfolios, and that's why we actually hold fewer government bonds currently than we would typically expect to do over the long term. That's helped protect portfolios from losses in recent weeks as those government bond prices have fallen. But from an inflation standpoint, we really remain relatively cautious on the inflation outlook. Central banks have become much more relaxed in their indicated approach and tolerance to inflation. The US economy is far from its full employment goals, and there's much economic slack or unemployed resources to make up in the economy. So we hold some inflation protection in our portfolios through assets such as gold and, of course, equities. But given the extreme level of government spending in the previous 12 months and the emerging economic recovery that we're seeing in the data, we still see much of the recent move in bonds as returning a necessary and more sensible risk premium to those assets, but also reflecting a more positive outlook on the global growth trajectory.
Thanks, James. So against this backdrop, how did the Nutmeg fully managed portfolios perform during the month of February?
Well, as you might expect, given what I've just said about market performance, it was another month where higher risk portfolios delivered positive performance due to gains in equity markets, but lower risk portfolios fell due to losses in bond markets. And that meant returns ranging from a negative 1.4% in our lowest risk portfolios to gains of around 1.6% in our highest risk fully managed portfolios.
So given everything that's happened lately and things that we might look ahead to shortly, have you made any changes to the Nutmeg fully managed portfolios?
In February, there have actually been a number of changes to portfolios. Firstly, we increased our overall weighting to equities at the beginning of the month as we continue to see positive signs that a consolidated recovery was taking hold. That has been buoyed not only by vaccine progress, but also the continued strength of economic data in the US, both the high frequency data coming through from January, but also the better than expected activity data from the final quarter of last year. Now, we also reduced our exposure to investment grade corporate bonds in February. These are high quality corporate bonds, but the spread or the compensation that investors gain over government bonds had actually eroded to all-time lows towards the end of January. And so we took that opportunity to reduce our holdings there, given we didn't feel the rewards were significant enough to remain overweighted in that asset class. And finally, in our higher risk portfolios, we also exited our clean energy investment at the beginning of the month. Now, here we actually still believe the clean energy theme is quite attractive in the long term, but the flow of money into what is a very narrow universe of stocks in recent months, particularly post the US election, has been extreme. And that's raised our concerns about overcrowding. We no longer felt that approach met our standards on diversification, and so we chose to exit at a healthy profit. For anyone interested in further details on that, we've actually written a blog explaining the decision to exit our clean energy exposure on Nutmegonomics.
Certainly a lot going on. Now, I know once a year you and the investment team review the strategic asset allocation framework that underpins the investment philosophy here at Nutmeg. Can you tell us a little bit more about what the strategic asset allocation is and what, if any, changes you've made?
Absolutely. So a strategic asset allocation is a framework that is used by investors to determine their long-term weightings across different investment assets for a given level of risk. So it could simply be interpreted as a base camp. It's the mix of assets that, all things considered, we believe is appropriate over the long term to achieve the optimal mix of risk and return. Now at Nutmeg, we have our own strategic asset allocation that's been built in-house by our investment team, and that acts as the base camp for our portfolios. It helps ensure we remain appropriately positioned over the long term across our portfolios, and it helps us manage our risk. And each year we review that allocation to ensure it remains best placed to guide our portfolios in the future, and we adjust it where required. Now, this year we've made a number of adjustments. Firstly, we've embedded ESG integrated funds within these allocations for the first time, seeking to improve their long-term risk and return characteristics. We already have a range of socially responsible exposures within our managed portfolios, but this further enhances our recognition of ESG factors in the management of our investment strategy. Alongside the use of some of those ESG funds, we've also made a number of other changes to the allocations as part of this review, including to the long-term currency mix and the level of UK home equity bias, meaning the high-risk portfolios now hold greater foreign currency and have a lower equity allocation over the long term. Now, these adjustments have already taken place, and again, they're designed to ensure portfolios remain best placed to deliver strong risk-adjusted returns in the years ahead.
Thanks, James. Sounds like it's been a busy start to the year for you and the investment team. We've had a look back at what's happened in February. Now I'd like to turn your attention to what we've got coming up. We're currently still working remote, although the UK government has set out its exit strategy from lockdown, hopefully for the final time, and the vaccine rollout continues to move forward positively. Does that mean that coronavirus is going to be less front of mind for UK investors as we move forward?
Well, I think COVID will certainly be embedded in the minds of investors for some time to come, but clearly the news of late has been on a positive trajectory. I mentioned in last month's update the interesting dynamic around the vaccine approach that's being taken across different nations and how that will really affect their ability to reopen their economies. We're clearly beginning to see the fruits of the UK strategy, but normalization will take some time, and there are sure to be some road bumps, emerging variants of the virus being the obvious one. But as the bond market moves show in February, confidence is picking up now that we're in a consolidated economic recovery stage. And we know that society will move forward and adjust. The emergence of topics such as vaccine passports shows just how quickly the world will adapt to a new way of operating. As for the UK progress, we're more positive now than we have been for some time on the UK stock market, given the potential for a really strong rebound in economic growth in the remainder of the year, particularly as the service sector comes back to life. As mentioned earlier, we're still favouring the small and more service sector oriented FTSE 250 stocks here, rather than their large cap counterparts. But we've also remained overweighted to sterling of late, as vaccine progress and higher bond yields have driven a higher value for sterling.
Thanks, James. And finally, this month's customer question comes via social media, and we've been asked, can I hold a stocks and shares ISA as well as a cash ISA?
Thanks, Kat. The short answer is yes, provided you don't exceed the annual allowance of £20,000 per year and you don't contribute to more than one of the same type of ISA in any financial year. So you can contribute to a stocks and shares ISA, a cash ISA, a lifetime ISA, and an Innovate Finance ISA in a tax year, but you can't have multiple of either of those. You may, of course, be wondering, why would you want to hold both? Well, the Bank of England interest rate is currently at 0.1%, a historic low. And this rate is the one that is used by banks to determine what interest rate they'll offer you on your cash savings accounts, including products such as cash ISAs. Despite the historically low interest rates, you may want to still keep some of your money in a cash account. At Nutmeg, we recommend you invest for at least 3 years and ideally longer. This will give you the opportunity to ride out any short-term market volatility. So if you're keeping a pot of money aside that you might need in the shorter term, then a cash option might be right for you. However, if you have a longer term time frame and you're comfortable taking some investment risk, then a stocks and shares ISA may present you with the potential for better returns that will keep pace with inflation.
Thanks, James.
Thanks, Kat.
And thank you for joining us. If you have a question for James or the investment team, you can leave them in the comments section below this video, contact us via social media, or drop us an email. We look forward to seeing you again next month.